The topic, obviously, as you know, is post-M&A and shareholder disputes. So we're going to structure this in sort of three broad parts. In the first part, I'll invite all the speakers to give an overview of the trends they're seeing in the M&A space, investment space, and of course, disputes as well. In the second part, we'll try to cover the disputes and issues we find at the outset of a transaction, so the entry-level issues and disputes that occur during the closing or post-signing or post-closing disputes in the M&A and investment space. And the third part, we will cover disputes at the end of that life cycle, exit disputes. So I think it's going to be a really good conversation. We'll try to make it into a proper conversation between all the panelists and try to cover all the main points as we go. So with that background, I want to first turn to Akila. Akila, can you just give us some context and some overview of what you are seeing in the M&A space right now?
Sure, Montek. So I think what we're seeing in the M&A space is a lot of deal activity, and there has been no, dull moment in our lives as far as M&A transactional space is concerned. But of course, the kind of deals have undergone a change. So like last year or the previous year, our PE and VC teams were very busy. And our strategic M&A team was busy, but not as much as the PE side. But now PE and VC have fairly slowed down. But the strategic side, we're seeing a huge spurt of activity, not only in terms of the number of deals, but also the pace at which they're moving. So they're moving pretty fast for large conglomerates, both the domestic ones, and also we see a lot of cross-border deals. And one interesting thing that's happened, at least in my 20 years of experience, the number of joint ventures that I have seen, I'm seeing a huge increase in the number of joint ventures we're doing, both in the private space and also in the minority-majority kind of space. So I think maybe this PLI scheme and other such initiatives by the government has brought about the need for foreign persons to kind of cooperate and collaborate more with Indian persons. So we're seeing a lot of JV action, which is quite exciting and much more than previous. So this broadly in terms of deal activities, and in terms of the nature, again, a lot of consolidation activities, both vertical and horizontal, the usual suspects in terms of sector. So I'm very optimistic about 2023 in terms of pipeline. Yeah.
First of all, good afternoon to everyone. I agree with Akila what she said, and just to add to what she said, India has defied the global downward trend, which was seen globally in the M&A space. 2022 particularly was a bumper year for India. As per Mint, the M&A activity was 152 billion. As per Business Standard, it was 172 billion. 2022 saw some mega deals in the aviation sector, banking sector, energy, infrastructure materials. To name a few, SDFC Limited and SDFC Bank merger, Air India and Vistara merger, Adani buying the port in Israel, Hafia port. Looking at that, and Biocon made a mega acquisition of its partners, biosimilar business from Vitaris. That was 3.3 billion. So we are very optimistic in 2023, this trend will continue. The large Indian corporates are looking at now portfolio optimizations, hiving off, divesting their non-core businesses. Recently, SR sold their port and power business to ArcelorMittal. Reliance and Tata's also had hived off somewhere around 25 to 27 of the non-core businesses in the last year. And we hope that trend will continue. 2023, I think India will continue with its growth path. IMF and World Bank have confirmed that India will remain as this bright spot for M&A activity. This was also very evident with the recent air show, where we saw the huge response from the OEMs. And this is the first time we saw a lot of CEOs showing their commitment to India. In the defense space as well, we are going to see more of M&A activity. Today, OEMs may not be always looking for defense contracts. They're also looking at how to have a sustainable supply chain. They might be looking at India to be the hub for sourcing to address their supply chain disruptions.
Thank you. Now to you, Andrew. What are you seeing from a more of a cross-border and international perspective?
Sure. So I think for me, what we actually need to do is to go a little bit back in time, because when COVID first started, appearing in our lives, the media, I think we all thought, oh my God, the M&A markets are going to go bust. At least for us on the U.S. side, we had sort of, the blessing in many ways, the harm in many other ways of SPACs. So, we went from having basically almost no SPAC exposure, and, let's remember SPACs aren't really new. I had actually worked on one in 2014 to suddenly, my entire life was basically SPACs. Obviously, that party has kind of ended, I'm sure, as you all know. I think there's still a number of SPACs out there that are looking for targets, and quite frankly, if you're a sponsor of a SPAC, you can make the argument it's kind of better for you to do virtually any deal rather than no deal. So we are seeing at least some renewed activity, I would say, in that space, but it's certainly calmed down. That's kind of the key trend, I would say, the last, say, 8 months. I think I would echo kind of what other people are saying, though obviously, I think India sounds a bit more buoyant than some of the markets outside of India. We're certainly seeing, more caution in M&A. So, I think as M&A lawyers, we're often telling our clients who have, unreasonable expectations as to timing, hey, you can't get this deal done, that's too soon, it's going to take 3 months as opposed to, 2 days. What I'm finding now is, we're not having to have those conversations. Every deal is on a simmer, people are much more methodical, they're thinking about things, and I really haven't been on any deals recently where there's sort of this rush from the business side to get this done within X period of time. I think there's a deeper appreciation for, getting things right, taking time to do your DD, making sure it's the right deal in this market with, all the risk that I won't bore you with, we're all reading about it in the headlines. Those are the 2 key trends I would say that I'm seeing.
Thank you. I should tell the audience, I didn't share all the questions with the panelists, so I have some trick questions I'm going to ask at different points in time. My first one is, and perhaps very quickly, because we obviously need to move on to the next topic, but so pandemic was the first sort of big occurrence in the last 3 years. Since then, the world has remained volatile. How have geopolitical risks or now increasing inflation in the Western world, I mean, frankly, some of these markets haven't seen such inflation for decades. Has that affected transactions at all, or the investments, or the risk profile? Maybe we'll start from Neeraj on the left very quickly and then go on to the rest. Quick comments.
Yeah, that's true. This is something which the world has not seen the last 2-3 years, what we have seen. There is definitely hesitation at the board level as a first instinct. The recession, the threat of recession, inflation is weighing on in their mind. But I think with constant awareness to them, this is also the great time to make successful businesses. This is a great time to make opportunity. This is an opportune time to look at their internally and externally to be competitive. World is looking at India, so I think Indian corporates have to look into India.
I think a lot has changed, Montek. From the sell side, there's a lot of nervousness in having a long period between signing and closing, unless it is a regulatory approval or a public M&A kind of a transaction where you have no choice but to wait. I see a lot of private M&A transactions. The starting point is let's sign and close together if we can, move everything to conditions subsequent or deal with it as a value depleter rather than have a lot of conditions precedent between signing and closing. On a generic level, the way we draft has changed. We are able to impress upon our clients the need for better drafts because they have seen the kind of risk that they've taken. So they do value our time spent on, say, material adverse effect clauses and stuff like that, which were normally considered extremely hypothetical. They've seen the world now and they kind of, are sympathetic to our time spent on these items. But yeah, there's a lot of drafting changes in terms of how we define things. And then there is the practical aspect of volatility in the market. Things keep changing all the time, so people need to move fast.
I mean, I was just going to say, I think for me, it's the sort of end of cheap money. So I'm working on a deal now. We have an equity investor who's trying to fund this acquisition. They came out with a term sheet for convertible preferreds. And I mean, we were looking at the interest rates and the IRRs. And at first, I think we had to pause because we sort of said, well, wait a second. This is kind of the new world. These rates actually might make sense now. But obviously, that's going to have a huge impact on financing, the ability to do deals, et cetera, et cetera.
Yeah. Thank you. So Shivani, now to you. So that's all the good news. Things are looking up, investments are up, but as we know, many times investments go wrong. Can you give us a brief overview of what are the general rights available to investors, shareholders, when things actually go wrong?
Thank you, Montek. Good afternoon, everyone. As you can tell, I'm probably the infamous and probably the least liked lawyer on this panel because I'm a disputes lawyer. But Montek, to answer your question, obviously in terms of the rights available to the parties involved in an M&A transaction, you obviously have things under the deal documents. Under the SPA, you would have, for a buyer, you would see heavily negotiated reps and warranties clauses. You would have price adjustment clauses, and of course that's important for both buyers and sellers. For the buyer, that they actually pay for what they're getting, and for the seller, that they get fair value for what they have sold. Apart from the contract and apart from the deal documents, you obviously can go to court and get equitable remedies. So that could involve specific performance, could involve, obviously you can get damages when there is a breach of warranty. But in terms of non-contractual remedies, you could obviously get specific performances. You could get a rescission of contracts, but obviously that would depend on what stage it's at. If it's pre-closing, rescission is more common. Post-closing, rescission is fairly limited, and things would have gone really wrong for that to have happened. So I would say those are the kind of remedies that would be generally available to parties.
Thank you, and that gives me the good runway for the main part of the day's discussion are the disputes themselves. So I think we'll start off where Shivani left off in some ways. Andrew, coming back to you, what are these MAC and ME clauses and why are they important?
Sure. So for those of you who don't know, we often have a closing condition in our SPA, merger agreement, whatever it is. It says, no MAE or MAC, material adverse change, material adverse effect, they're the same thing, has occurred. Obviously, you can get into a lot of discussion about what that means. The trend, at least in our practice, has been to negotiate these, really spell out what these clauses mean. So when I started practicing, I remember there was a partner and he used to say, hey, it's funny, we spend all this time negotiating these clauses, days and days, pages and pages, and a Delaware court has actually never determined that an MAE has existed. His point was obviously, hey, it's kind of, a waste of time that we're doing this, ha ha ha. That was all true until sort of 2018 when we had Cohn versus Fresenius, a case in Delaware where actually an MAE was determined to have occurred. I should point out this was a pretty unique set of circumstances. So, the target had revenues that were dropping something like 30% quarter after quarter, so cumulatively. There were also some allegations that they were engaged in fraud in licensing or obtaining the licensing of some of their medical products. So there are all sorts of issues. And in that case, the court actually said, well, hey, this is maybe the one instance where an MAE has occurred because this is A, so severe, and B, it's durationally significant. There wasn't any sign it was going to get better, and also because it wasn't sort of affecting the industry generally. Now, I should point out that it's rumored to have been the longest opinion in the Delaware court's history. It was like 260-something pages. So they also went to great lengths to say, we're going to honor what people put in their contracts. This is a pretty unique circumstance, et cetera, et cetera. So it's still very hard. It's a very high bar to prove a MAC. That's kind of the good news if you're a seller. The bad news is we still continue to negotiate these a lot, and it's very, very important for clients to pay attention to this. So I think some of the key sort of points that I would look at are, is your MAC MAE forward-looking, or does it only cover the past? That's a key point. The other key point are really the carve-outs that people typically try to put into this. So, is it industry-specific? COVID became a big one. I mean, I would say it's borderline malpractice to not put COVID measures into your MAC clause now. But before, I think maybe I'd seen pandemic and riot and terrorism in one sort of, lumped bucket, and now COVID itself has its own bucket. So I think it's very important to pay attention to these exclusions to try to avoid disputes down the road.
Thank you. And Akila, you mentioned this briefly in your introduction about the importance of spending more time on these, especially the background, what's happened in the last 3 years. What's the Indian perspective on these clauses?
Yeah, it's very similar to what Andrew outlined. So in India, mostly in share purchase agreements, I don't think we have a single share purchase agreement where there is time between signing and closing, which doesn't have a material adverse effect clause. So to that extent, it's fairly standard for the purchaser to expect it. The language varies. If it is somewhere where the people think it is hypothetical, where it's like a solid business, where people are comfortable, then the language is what is very generic. So they get away with using stuff like material impact on the business, the ability to consummate and stuff like that. But in some cases, we have seen where there is more volatile business, where there is some level of uncertainty, then parties have gone forth and come up with more granular definitions on what would be a walkout right. Is it like 20% change in business, 20% change in sales? What is that? So they try to make it more clear, to make it more enforceable. Yeah. So we've seen both sets, and the latter is, maybe 20% of what I've seen than the former. And of course, clients, we do spend some time on what is material, should we define material, the usual lawyer fund discussions that we have, but typically we don't define material if it is a generic clause. We leave it to the facts and circumstances of the case. And in terms of enforcement, there are not many precedents, at least in the private M&A space. And in the public M&A space, of course, it's very difficult to have such clauses because you normally may trigger an open offer, and then that cannot be reversed. You have to go through it. And our regulator, though our takeover regulations do provide an ability to withdraw your open offer if certain things are outside your control, our regulator does not really entertain such requests unless it is some other regulatory approval and you have done everything that you can. Even there, you may have to pay interest and, there are a lot of issues. So in the private M&A side, it is par for the course. It is very standard, still highly negotiated. And on the carve-outs that Andrew mentioned in India, it is very standard to have them. Very rarely does the seller not have those carve-outs. Normal carve-outs, though the language differs depending on the sector.
Thank you. I think just building on that, Neeraj, coming to you next. So I think it's quite sort of non-controversial to say this, but simply the contract becoming more onerous to perform is not good enough. So what is the threshold really? And what is the evidence that's required to establish a material adverse impact on the business?
Very difficult question. I'm not a litigator. But let me just try. Look, my advice to my client, because as a person and as a corporate M&A, my advice to my client is that it should be a well thought through clause. More you keep it broad, vague, and subjective, it's more likely that the courts, you'll get into the legal system interpretation and you will not be able to walk away. More you make it more objective, better chances of you being able to walk away if there is a MAC or MAE. Sellers definitely like to keep it more open because so that it becomes difficult for the buyers to. So when it comes to enforceability, the burden of proof on the buyer is huge. And even if the buyer is able to prove that there has been a severe impact, financial impact on the business that it was thinking of buying, the courts are going to get into whether it's severe and enduring. Is it affecting the industry as a whole? And if it's affecting the industry as a whole, are you worse off than the impact on the others? So we're getting into a very different ballgame altogether. So my advice to clients has always been that try to make it more objective. Because all said and done, if you have thought about a deal, this clause should not be used to get out of the deal, because it's a lot of people have spent a lot of time, effort, energy, and it should not be misused. Sometimes even the sellers are today misusing it. Particularly during COVID time, the valuations were down. Nobody knew when we were going to get out of the COVID. But fortunately, India got out of the COVID very soon. So they have started looking at valuations again. So I think that's what we have to live with.
Yeah, but don't give that good advice because my work will go away. So Shivani, coming to you now. So obviously we've heard a bit from the corporate partners. Often they still get triggered. Often you still go into a dispute, and very often it's arbitration. What's your view of how courts and tribunals generally view this issue, particularly, again, building on what Neeraj said on the threshold, and of course, consequently, if the deal doesn't happen, there's obviously a question of damages and remedies. So how have courts and tribunals approached this issue?
Thanks, Montek. So first of all, I agree with what Neeraj has said. And what I'll do is I'll add the UK perspective. And the UK court's position is quite similar to some of the points that Neeraj touched upon. And in fact, the leading judgment on MAC or ME clauses in England is a case called Grupo Hotelero versus Carry Value Added. This was a 2013 case by the English High Court. And in this case, the High Court said that the bursting of the Spanish property market in 2008 was MAC that allowed the borrower to get out of the transaction and to terminate the transaction. And in this case, what the court did is that it laid out certain guidance for when a MAC would be triggered and a party can walk away on that basis. So obviously, first of all, the party which alleges the MAC bears the burden, and I would say rather high burden, of proving that a MAC has occurred. Number two, a MAC has to be material enough and significant enough to affect the company's or the entity's ability to perform its obligations. By that, what it means is that it cannot be temporary in nature. You can have an event which is temporary, but the impact should be long-lasting for the MAC to be triggered. Also, by definition of MAC, material adverse change, a change needs to be involved. So what that means is an entity cannot claim MAC to get out of a contract on the basis of something it already knew at the time of closing or prior to closing. It has to involve something new, or what it knew should have materially changed for the MAC to be triggered. When you talk about a company's financial conditions, and the MAC clause or the ME clause is linked to that, the company's financial condition needs to be worked out on the basis of its own information. So, for example, management accounts. And you will not take into account things like external market changes or external economic changes, unless what has happened is so widespread. Like Neeraj said, it's something that's affected the entire industry, and then you see what's the impact on that particular entity. So I think just to sum it up, as Akila said, in terms of a MAC clause, it really depends on how it's drafted. Obviously, the more specific you are, the better chances you have of it being triggered and being enforced. But obviously, it depends what side you're batting for. So you may want to have it more vague or more specific.
No, thank you. And before we move on to the next sort of sub-segment of this session, I'll just throw another issue in the mix, just from a slightly different angle. I won't answer the question like a lawyer, but I'll just raise it. If you are successful in triggering an MSC, the question becomes, unsuccessful in triggering an MSC as a buyer, the question often becomes of damages for the seller. And unless you have limitation on liability or the breakup fees, the usual sometimes compensation standard is the new price, the value you can get for the same business. So let's say I agreed on 100. Now if I go out somewhere, I can only sell it for 75, so you might be able to claim the difference. But there's an interesting overlap with that damages question with the legal point which has been discussed right now. If your damages calculation starts to take into account a very large effect on the valuation and something that's fundamentally changed the business, does that then make your legal case trickier? Because your incentives as a seller have changed now suddenly from a liability to a damages question. In liability, you want to show it's not materially adverse effect. On damages, you want to obviously increase the number you can claim, and therefore you want to reduce the value of the business now. So that's an interesting question that sometimes we have to deal with, but just another point to keep in mind if you're thinking about triggering the MSC clause. Now moving away from MSC, now let's go to purchase price. Right? That's the other hot contention at the entry level. So Neeraj, before we come out to the disputes where we see in purchase price, what are the key considerations that you are keeping in mind and advising your client when you're agreeing on purchase price, and of course the mechanism to agree on the purchase price? What are the key considerations for you?
I think you're putting all the tough questions to me. Because as lawyers, the client tell us what the purchase price is before they approach us. They consult you guys or valuers. But because it's an ABA India conference, I'll answer that from a cross-border perspective. I think the key consideration, legal consideration, is our RBI pricing guidelines that need to be adhered to. To some extent, our RBI pricing guidelines are disadvantageous to a foreign investor because he cannot pay less than what the valuation is arrived at. And he cannot take back more than what the valuation. So I think the key considerations are first the purchase price should fit into that valuation as per the RBI guidelines. Then the other consideration is, are we paying upfront? Is there going to be a deferred consideration? Very common we are seeing now is the earn-out provisions. Now that itself is a huge topic of debate, how the earn-out works out and how that sets also the recipe for further disputes, because then you're dealing with a very optimistic seller and a skeptical buyer. So earn-out provisions, deferred consideration, whether you're paying upfront, the extent of reps and warranties and the quality of reps and warranties. Then our favorite M&A world, de minimis, indemnification baskets, aggregate baskets. Now all those becomes key considerations. The other key consideration is when we get into a debate whether we should have a sandbagging clause or an anti-bagging clause. In a sandbagging clause, at least it gives the comfort to the buyer that, look, whatever seller has, he's not scared off. But if he negotiates heavily on that, I think they need to look at, again, the purchase price. So I think these are the main key considerations. Yeah.
No, thank you. Akila, coming to you. Now, obviously, notwithstanding all of those considerations, things still go wrong. So what are the adjustments you often see to purchase price? And what are the disputes that come out of those adjustments?
Yeah, so I agree with all of the points mentioned by Neeraj, and we don't see a lockbox kind of an arrangement anymore in any transaction, unfortunately. So, and the purchase price adjustment is definitely there no matter what sector transaction we do, and sometimes it is very simple, like just a net working capital which need to be trued up, and it's not complicated. We have seen so many transactions very nicely complete a purchase price adjustment after closing. Nobody's disputing anything. Everything is very pleasant, where there's no disputes because it is simply drafted and there is no problem. But I think where the problem arises, I think, is in the earn-out space more than simple purchase price adjustment, because a purchase price adjustment is just a true-up of something which you've already agreed. So you have one valuation when you sign, you have a schedule saying how you have conducted that valuation, what are the parameters. There is no change in the principles of accounting or anything that changes. The time span is just around 3 months or so. So for you to true up is not big a deal, and we hardly don't come across that many disputes at the time of purchase price adjustment. But on a plain vanilla matter. But where we do come up with, sometimes we have seen in the recent past, is due to the exchange control issue that Neeraj mentioned. Especially if there is no buffer in your fair valuation certificate, where you have kind of done the transaction originally at the same valuation at which your fair value certificate is. And suppose you had to either pay more to the non-resident or something like that, where the FEMA laws do not provide. Going to an RBI approval is always problematic, may not be forthcoming. So now we have gotten smarter, where we firstly provide for who has to get that approval, if that approval is required, how the time spans change in all of the clauses if that approval is required. And if for some reason at the option of one of the parties, we even structure it as an indemnity payment rather than as a purchase price adjustment, because there are all these technical forms that we file when we do the transaction, especially if it's a fresh issue. You file certain forms with the ROC, and then for you to change that share subscription consideration afterwards is a little bit of a challenge. Some of the recent transactions, we have been doing these purchase price adjustment not attached to the share, but as a separate indemnity payment, which is kind of working, and I think the tax per people have also kind of signed off on those things. So that's one set of purchase price. The earn-out is a different story altogether. And I think we see a lot of earn-out structures now in almost all the tech deals, or any transaction where the value is all, future-looking, and company is not making profit, but there's a huge valuation expectation. There's a delta between what the seller and purchaser want. So there we see an earn-out structure, and it is successful. We have, like, for example, I'm not sure if it's in the public domain, but there is one transaction we recently did which had an earn-out structure. We are now on year 3, and all 3 years they have had no disputes in the payments. I think it normally works when the seller is not fully exited. He continues to be like a minority shareholder or an employee of that company, and he's incentivized to take that company to the next level, both in his employment contract and as part of the earn-out. So this combination has worked very well in making sure the earn-out interest is aligned between the buyer and seller even after the transaction. But where disputes arise is if the seller is exiting. Seller is no longer in control of the company. We lawyers could draft fancy clauses on the standstill and how the company will be run between signing and, during the earn-out period, which is normally at least 18 months to sometimes more. And no matter what we draft, how to take a particular cost, whether it is a one-time cost or a particular revenue is a windfall revenue or to be factored in, there's a lot of disputes, and that's where people like you, Montek, have a very good career prospects ahead. So earn-out, in that segment of earn-out is where I think most of the disputes lie.
Yeah, no, thank you.
I just want to add to what Akila just said.
You have 30 seconds.
Yeah, 30 seconds. Less than 30 seconds. I totally agree that we are now doing a very crafty way of breaking the purchase price and the indemnity. Income tax department is fine because they're getting more tax, because instead of capital gain, it's getting into a revenue. But of lately, we're seeing the stamp collector offices. Oh man, if they get into your share purchase agreement or shareholders agreement, you add it.
Good. I'll just say one thing, but I know Shivani has a view on this, but Akila, you said that purchase price sometimes, at least in vanilla cases, you don't see much disputes. Our experience has been completely different in some ways. So just for audience's benefit, and I'm sure you know this, but the usual 2 ways of purchase price adjustments are either lockbox mechanism. So you take a historical period and lock the accounts as of that date, or completion accounts, which is it's still ongoing, and you agree on adjustments at completion. What we see, at least in lockbox, is there are quite tight mechanisms of what can and cannot happen after lockbox. But the questions that arise, are some of the transactions therefore fraudulent, or has the money been moved, leakage of money through the business. Sometimes it could be a long period before the actual closing happens. And in completion accounts, notwithstanding whatever schedules you've agreed, people dispute about, is this a debt? Should this be an adjustment? How do you deal with non-recurring items, extraordinary income, extraordinary costs? So we still see a lot of disputes on that, especially if these items are obviously material. But sorry, I just want to say that because that's something we are seeing quite a bit. But Shivani, I think you had a view on the earnouts and some of the topics we've been discussing right now.
Thanks, Montek. I just wanted to actually talk about both Neeraj and Akila mentioned about earnouts. No, I think Neeraj is better. Both of you mentioned about earnouts and disputes in that context. And Neeraj, you mentioned, when there are earnouts, it normally involves an optimistic seller and probably a bit of a skeptical buyer. I just wanted to mention a case in the English High Courts where the reverse kind of happened. So this is a transaction which involved an earnout and a deferred consideration to the seller, depending on how the business did. In this case, the buyer had given certain warranties to the seller, saying that when they take over the merged entity, they were going to merge this business into their entity, and they said that they are not aware of any issues that affect the business of this entity that is going to be merged, including the customer base and all of that. The merger happened, and after that, one of the main clients from the buyer's side, the business from their side completely dropped. And this, of course, meant that the seller would get no deferred consideration at all. So their earnout was practically zero. And then the seller sued the buyer for a breach of warranty. And the buyer said, well, my warranty is quite vague, so you can't really enforce it. But the court said no. And they allowed the seller to successfully sue for breach of warranty, the buyer for breach of warranty. And I just wanted to mention this case because it just shows in an earnout dispute, things can turn out quite differently from what the parties would have anticipated before they got into that provision.
Thank you. And I think the final comment on earnouts, just again to keep in mind, is I think Akila mentioned this actually, but the exam question often is if you haven't met the targets, who's at fault? And is that something you can pursue an action for? And that's interesting because, again, as Akila mentioned, is incentives change after the transaction. The buyer has a different incentive, and the seller has a different incentive. The seller is more concerned about short-term performance. The buyer might be concerned about long-term value. So again, things to keep in mind, but I think those become tricky questions, especially if you want to bring a claim for earnouts not being met. And sometimes those are relevant enough because the amount at stake for earnouts have increased substantially in the especially last few years. Moving on, we're slightly behind schedule, so I'm going to ask the panelists for the next topic to keep it as brief as possible, because I do want to touch upon exit disputes. So the next subtopic is misrepresentation and breach of warranties. Hot topic. And I think a lot of action has been seen in that space for decades now. But Neeraj, I'll start with you again first. You've been complaining I've been giving the tough questions. I'll give you an easy one. And if you say this is tough, then... So I was going to say that next. You have 1.5 minutes for this question. Why are reps and warranties important, right? And why they're so critically negotiated in any transaction? What are your views on that?
I think reps and warranties are fundamental to the buyer's decision to proceed or not to proceed with the transaction. Notwithstanding a due diligence done by the buyer, they need comfort on what they are paying for, what they are bargained for. And reps and warranties are one way to give them the comfort that what they are buying is correct. And because it's fundamental, so there's a laundry list of reps and warranties which have to be negotiated to cover each aspect of the company as well as the business. So you will get into first that whether the seller and the buyer have the authority to sign the document and to consummate the transaction, then you get into financial statement reps and warranties, assets, liabilities, litigation. With cross-border transactions, you also get into tax avoidance, um, corrupt practices. You negotiate on those. Environment is big, and that's also pretty debated reps and warranties because environmental laws, the way they are worded in India, even if you have found something during the due diligence process, it becomes knowledge to the buyer. And you step into the definition of occupier from day one. So you need to be very careful when doing a due diligence. And if there's a finding, either that needs to be resolved before, because then buyer at later stage, even if he has taken a rep, he cannot get out from the regulator and the licensing authority's perspective. That's 1.5? Or I've
Slightly over. No, that's very useful. I mean, in principle, obviously, these are all mechanisms of risk allocation. Right? You're trying to allocate risk between buyers and sellers. So I'm just building upon that. Notwithstanding, again, all the clever lawyering, you still find disputes. And can you talk us through what kind of disputes you see in this space, and what are the critical factors to keep in mind as you navigate these disputes?
Sure. I mean, maybe first just a practice note in case you're not aware. So if you're ever dealing with a U.S. governing law and you have a contract, reps and warranties are actually the same thing. There may be some slight nuance around the courts, but we don't have sort of the separate concept of these two things. So when I say rep and warranty, I'm meaning warranty probably to some of you depending on your jurisdiction. To your point, Montek, typically I would say even where we have a condition, I've almost never seen a deal fail because a warranty wasn't true and you breached a condition to closing. I think if you're at that space, you're having a broader discussion about other things and you're probably going to walk away. Where we do see these things, though, are when you actually have a breach, you've closed, somebody's seeking damages. And I would say, to be honest, I've only ever seen two flavors of that. The first is it's de minimis and people, agree. The second flavor is obviously it's something massive and, there's a huge sort of disagreement as to A, whether it's a breach, and B, the materiality of it. So I think as a key practice point, you need to involve your business people and your warranties sooner rather than later. I think M&A lawyers like to sort of operate in a silo. Your business people need to be reading those, but I think actually much more important to avoiding a dispute are your disclosure schedules. So I'll try to be brief, but in every deal I've worked on, I don't know why it's some unwritten rule of the universe says we're going to ask the company to draft the disclosure schedules 2 days before closing or signing rather, and invariably somebody is tasked with doing that. They're not going to have time. They're not going to have time to ask the right people, and something's going to be missed. So I think the best thing that we can all do to avoid disputes is to get our disclosures right and keep that front and foremost in the process.
Thank you. Akila, very quickly on this, notwithstanding trying to avoid the dispute, you find yourself in one. What are the remedies then available?
For breach of representation?
Yes.
No, but I'm in vehement agreement with Andrew on the disclosure schedule point. I think future step plans for acquisitions should start with prepare disclosure schedule, then do term sheet, because it's always the last thing to do and causes a lot of anxiety. To answer your question, Montek, on remedies, so again, I agree with Andrew that very rarely do we come across a breach of rep or a warranty before we close. So because normally there's a bring down of all of the reps, and we do have a concept in India, I think it's prevalent outside India as well, on an updated disclosure schedule. So that is again a very highly negotiated point, because when you sign, we give a disclosure schedule, but if there are 3 months between signing and closing, things could have happened. There we, normally the standard now is that the seller has the right to update that disclosure schedule, so long as it is not a material adverse effect, and if it is reasonable, the purchaser is bound to act reasonably and accept those disclosures that is freshly made. Sometimes if the purchaser has a higher bargaining power, the purchaser would say that he has the right, he's okay to accept it, but then he has the right to discuss specific indemnities. And in such cases, and there are other cases where we have seen where we've also agreed that, okay, you don't accept it, it will not be a carve out of your reps between signing and closing, but then I want to put it out there so that I'm not embroiled with any fraud allegation in the future as well. So these are some things that happen on things. In terms of remedies, again, normally it is an indemnity, and again, the whole quantification of that indemnity, who should prove that indemnity, who suffered that loss, what kind of loss, all of those principles come into being. And that a lot of things don't go to court. So we see exchanges of letters, sometimes even a legal notice, then parties settle if it is not very big. And sometimes it does go to court.
No, thank you. The only thing again I would add from a damages perspective is, well, two things. First, obviously, and I think this was again covered before, while in some cases, the decision is available to you in theory, it's extremely difficult to apply, especially if it's a post-closing, obviously, breach, and it's 3 years later, it's often difficult to unwind the transaction. The second, at least on misrep, and again, I'm just raising questions today, I'm not going to answer any, but a question to keep in mind for misrep and breach of warranty claims is the usual compensation standard, again, in most contexts, is what's the value you were warranted, what did you pay for, assuming these warranties were true, and what have you received? What's the true value of the business? And the important sort of sub-theme to that question is, when do you measure that value? And often it's at the closing date. So you can't take into account hindsight of what's really happened. So usually the measure of damages becomes the difference in the price you paid and the price you would have paid had you known about the true picture of the company. And to Andrew's point, sometimes these breaches are very material. Let's say a critical asset has been misrepresented to you. So that can really affect the price you would have paid. Right? So again, something to keep in mind if you're claiming damages on that. Now, the final and perhaps one of the more interesting topics is exit disputes, but we don't have as much time as we had allocated for it. So we'll keep it, again, quite brief, but crisp. Andrew, I'll come to you first. Obviously, for any investor, especially private equity or JV, exit is critical, right? So what are the rights that you often see which are available to the parties to exit the transaction or exit the investment?
Sure. So I think we need to sort of distinguish between kind of a friendly exit and an unfriendly one. So sticking to the unfriendly one, there's a deadlock or some party has done something bad. We would see a wide range of things. So a put and call option to sell or purchase those shares at an agreed, discount or premium. I'm sure, Montek, you probably have a very good business arguing about valuations and what's in the contract. That's one. The second we might see is Russian roulette, where one party has to offer to sell and purchase at the same time. They don't know what the other side's going to do. We still occasionally see what's referred to as the gin and tonic agreement, whereby senior representatives of each party are meant to have a gin and tonic and agree to resolve their dispute or agree to purchase or sell the company. We then also have the sort of voluntary exits. So, major shareholder is selling, they get to drag the other shareholders. Typically not much dispute around there, though often we do see a price trigger, whether that price trigger has been satisfied, particularly if the consideration is share consideration and not cash. It may not be easy to figure out whether you've actually hit that valuation. You often see tag-alongs, so your minority wants a way to get out as well. And then obviously the last would be the IPO. So we see a lot of agreements to talk about a forced IPO. What we like to tell people is, in reality, you're never going to be able to force a company to IPO for a variety of reasons. But if after 6 years you haven't IPO'd, at least it's a good reason to have a discussion, and a shareholder who has that right can at least dangle that to get some sort of concession out of the company, maybe get an exit from a major shareholder if you're, say, a 10% holder or something like that.
Thank you. Thank you very much. Now, Shivani is building upon that. So more options to exit, more chances of dispute. So what kind of disputes are you seeing in the context of exits?
Thanks, Montek. So I agree with what Andrew said, and you often see disputes relating to put and call options, to drag along rights, tag along rights. And often what it boils down to is just the wording of the contract. And what the court is essentially doing is applying the reasonable person test to interpret how the contracts would be need to be interpreted in the right manner. One of the recent cases that came up in the English High Court involved drag-along rights. In this case, the minority shareholder refused to comply with the drag-along rights. By the way, this case is Cunningham versus Resourceful Limited. And this was in 2018 before the English High Court in the Chancery Division. And the minority shareholder refused to comply with the drag-along rights on the basis that the sale by the third-party purchaser was not a cash sale, which is what it was intended to in the beginning, but it became a share exchange. And what the court ultimately said is they looked at the words of the contract and they said the consideration could be cash or any other consideration. And the court said this meant that a share for share exchange is fine, and they forced the minority shareholder to comply with the drag-along rights. So I think from a disputes perspective, what it really boils down to is interpretation of the contracts. And the clearer the contracts are, the better it would be interpreted.
Thank you. I do have a couple of questions left, but at this point, I want to just open up to any questions from the audience. Time is short, so I would prefer questions over comments. So if you have any questions specifically for the panelists we have today, that'll be great. Any questions from anyone? Yes, Simran.
Look, if you have a very well-crafted exit, if there is a dispute, you put call, drag, tag, whatever it is. Sometimes what happens is, despite having these clauses, exit options in the agreement, some lawyers will advise their client that if you go through that route, it might turn out to be more expensive. And that leads to what is called the board disputes. So you create situations within the organization to get the disconnect, and then either approach the court under operational mismanagement or deadlock. So what could have been the voluntary, and as per the contract, you have actually moved it to the court. Because by that time, first of all, it's a very bad strategy to do. Because it's not that money should be the driver, because you're actually impacting the value of the company, what you have created. Just to save a few bucks, routing through the court so that there's a forced exit. And if it's a forced exit and the court has also realized that one shareholder set has to go, then the valuations are pretty decent. But in that whole process, some value destruction of the company has happened, because once you get into that mindset, you're so much entrenched into your position that the business objectives and the long-term vision get sidelined. Thank you.
Yeah, thank you.
Thank you.
Thank you.
Okay, thank you.
All right.
Yes, please.
Regarding sandbagging or anti-sandbagging provisions, disputes regarding those provisions, it seems to be a hot topic and hotly negotiated in every transaction.
In India, unfortunately, it's very limited. But recently, Bombay High Court in GWL properties matter upheld the buyer's contention because the seller was contending that the buyer was aware, knew that there is already a breach, and still proceeded with the transaction. So the courts held that even if the buyer knew, but he still bought the business in reliance of your reps and warranties, so they did upheld the buyer. But to avoid those kind of situations, it's better to negotiate upfront an sandbagging and sandbagging provisions.
I agree with Neeraj, but just one point from a UK perspective that I can add. So the UK court's view, and again, it's not established because there hasn't been enough jurisprudence, but in one of the cases, this is Infightlund versus Artisan Contracting Limited. This is in 2005 by the Court of Appeal. The court basically held that if there's an anti-sandbagging provision, that can be relied on. But if there is a pro-sandbagging provision, it doesn't really have much value. So for example, a buyer can bring a claim for a breach of warranty under a if they have a pro-sandbagging clause, even if they knew of the breach prior to closing, but the court would only award nominal damages. So in effect, it doesn't really have much value.
I'll just make it even more complex for you. I think, and again, my role is moderator today, so no answers, only more questions. I think the one question, and just building on what Shivani said, it becomes important to distinguish the importance of prior knowledge on the liability itself from damages. And they can play differently on both questions. And in damages, you still have to show, I mean, like I said, no answers today, but you still have to think about causation, and you still have to think about whether your purchase price already reflected that knowledge or not, right? No more than that. But thank you very much for that question. Any other questions? We have 3 minutes by that watch and 3 minutes by my watch. So any more questions on this? No. So I'll ask a self-serving question then to the panel. As, we've touched upon this theme throughout, and again, this is to everyone almost, especially to Shivani as well from a disputes perspective. Many things we were discussing today, the remedies end up being quantification of damages or valuation considerations. How might parties present their best case on these issues in an arbitrations, and how might experts, what role experts might play to answer those questions? I'll start with you, Akila, first.
I think the fact that our firm and your firm work so closely proves the point, Montek, that we cannot do our work without experts like you. There are limitations on counsel advice or our ability to prove loss or quantify loss, and that's where I think the kind of service that all valuation firms provide is invaluable. Because things have now become extremely complicated on such calculations, and the courts have also started to look at these things with a more sophisticated mindset. There was a time when valuation was some kind of a black box, that courts did not intervene, as long as the report is from a credible firm, they would definitely go by whatever it says. But now both courts, SEBI, regulators, are starting to look at, okay, is this the correct method? Is DCF sufficient? Are there comparable companies? Why are you using net asset value in this day and age? Why is this transaction a related party of book value? So a lot of these kind of courts are getting more sophisticated in dealing, and they're comfortable going into a little bit more detail, and that's when having experts like you makes it easier for us to prove things. Yeah. Out.
I mean, maybe just very quickly, I was going to say, I agree, it's great to have experts, but particularly, I think, in the closing adjustment space, it's important to get those experts involved before you get to litigation. So, I mean, if you have an adjustment mechanism, we often have a balance sheet in there. I'll basically get one of the big four to try to, or I'll try to get them to bless that balance sheet and all the line items. Now, they, I think, internally have gotten a bit more savvy, and they seem to have policies saying they won't do that because they know that email where they blessed that and then they discover there's a problem, it's going to come back to bite them. But, I still always try. So, experts, I think, need to be consulted before to keep you out of the litigation, which I suppose is probably less profitable for you, but better for our clients.
I agree with both of those points, and I think there's not much more to add, but just to say that the use of experts at an early stage is really, really key. And the courts and tribunals are very, very alive to the issues that affect valuation. They're quite educated and in line with what is happening. So you would, as Akila said, the courts will not just accept things as coming from a particular valuation company, but they would look at the relevant commercial considerations to see if those have been met.
Final word.
No, I'm a fan of valuers. I love them. But sometimes they also raise issues which becomes very complicated. For example, off lately, Big Fours have taken the view that if you have a put option or a call option, it's a liability. So it has to be shown in the balance sheet. Come on. Right now, we're all discussing, there could be disputes around that. So before they take that position, I think they also need to back their thought process, and keeping it open always leads to problems. Thanks.
Yeah, I'm not a big four. All right. With that, all I have to say is thank you very, very much to this panel. A special thanks to Shivani, who came in last minute and was so well prepared. And thank you very much to this audience. Yeah, thank you.